Welcome into this new webinar by Finance Watch. I am Aline Fares and I'm going to take you through the capital food chain. So the capital food chain has nothing to do with this colorful and diversified picture that you have in front of you of life under the oceans. It's more looking like what you have above, numbers, following performances, checking for the generation of profits, and so on and so on. And this is the world I'm going to take you through. So the idea of this webinar came following and of this webinar and all this issue of looking into the way finance is working and who are the key actors and how they behave and why, etc., etc. The idea of these webinars came as we conducted a research in 2015-2016 on the representation of the public interest in banking. You can find the conclusions and description of this research in a report that was released in December 2016 called The Representation of the Public Interest in Banking, and it's available for free download on Finance Watch website. And this research was asking, why is the representation of the public interest in banking and in finance in general so low? Why is the public not managing to take and bring its issues through into the regulatory process, into how banks behave, into the activity they conduct, etc., etc.? And we came with this sub-question that is as important, is if there is so low representation of the public interest in banking, it's maybe because there is a very low participation in the issue of finance in general. So we came with the second question, which was what blocks public participation? And when we've been meeting organizations, representatives and activists and researchers along the process of this research and ask them what blocks participation of the public in banking, what blocks your participation in issues related to banking and finance. There were a number of responses that were given to us, and there were a number of suggestions that we explored and discussed with all these people who participated in the workshops we organized. And among these proposals, there were the need to create safe spaces, moments where people from the public, people from organizations, organized NGOs and so on, would be able to discuss finance and banking in their own term, trying to understand banking and finance in their own term, and therefore express an opinion on this and start to come up with ideas on how to change this situation. On policy end, there is also a specific context, which is that we had the crisis almost 10 years ago, the financial crisis, that has completely distressed public finances, public budgets and spendings. And one of the conclusions is that there is an increased reliance on private capital. And you have projects for development that are called now finance for development or finance for employment, or we find projects and programs with finance for everything to solve any kind of problems. And this requires that we more and more get a basic understanding of finance to formulate an informed opinion on all these policies that are being designed, and to be able to formulate an informed opinion on during public debates that relate to these numerous issues in which finance is now tightly intricated. So this webinar will ask, as a start, who are the key actors on the financial markets, and try to respond to that question. How do they make their investment decisions? And I will introduce some references as suggestions for ways for a change. So very basically, to start with, in our society today, when we want a project, a human project, to happen, there is at some point a need for three major things. And this project being the production of something, the production of an object, a tool, a product, a production of a service works also. And to make these human projects happen, and I will focus really on the production, the industrial production, and the mainstream production, you need labor, people who work to make these things, or to make the machines that make these things, or to take care of the maintenance of these machines that make these things. So you need people. You also need natural resources, because you need either wood or metals or whatever resources, even water and whatever resources that come from nature, that are produced by earth and nature, that are needed to create these products. So you need labor, you need natural resources, and you need capital for these projects to go through, for these people to be paid, for these natural resources to be extracted and transformed. And then you go through the process of making the product, and come a number of products with diverse usefulness. And this is what is represented by this little series of pictures. Of course, there are what we call externalities to this production. Externalities in terms of waste, in terms of pollution, in terms of human health, we could say also in terms of animal health and living condition. These externalities are not so frequently considered as part of the making of production, but they are really a key issue we are confronted with, and they are an issue why so many organizations now, so many civil society organizations are interested in how things are being made, where does the input comes from, and therefore comes the question, why is capital going in this direction and not that direction? How can we direct capital in the direction where externalities are not so dramatic as what we see today in mainstream production? So if we look at a company and how it is being funded, you have two types of funding for a company in a capitalist world like ours. You have equity, so the funds of the owners of the company, those who have created it, or those who have bought it afterwards, or those who have entered the company at some point. The capital owned by the owners of the company. It's the equity. And you also have the debt, so borrowings to other persons or institutions. There are different entry points, we would say, and forms of fundings also. So if you look into equity, as I said, you have the capital that has been provided at inception. But you add to this also the profits that have been accumulated over time. Then the company can go for a loan. And in general, the first step in terms of loan is the loan to a bank. It can be a short-term loan for short-term use. For example, when you need to make the balance between the moment you sell a product and the moment you get the money for the selling. So in the short term or in the longer term for the funding of longer term developments, for example, or for buying material to start a new activity and so on. Then the company can also issue bonds. And this is another way to increase debt or to get funding through indebtedness. Bond issuance is about borrowing money not from a bank, but from the markets. And the major difference with a loan is that you borrow from a number of people who can then, with the bond that they have in hand, so the financial assets that they have in hand, which is a promise that the company will pay back at a certain point in time and pay interest, they can sell this bond if they don't want it anymore. Sorry. Then there is another way of increasing the funding of the company and increasing the capital that the company can have at its disposal to develop its activities, which is the involvement of new investors through capital increase. And here you will increase the equity. So the equity is transformed into shares. So shares are pieces of equity. The debt, as I said, can be transformed into bonds. These are pieces of debt. So shares and bonds are financial assets. And when we talk about banking credit, it's a bank loan. So who are the people, the investors who buy those shares and those bonds? Well, you have individuals who are able to buy shares and bonds because they have savings and willing to pick their shares and bonds themselves, maybe with the help of a bank. But you have individuals, but they are not a big share of the bulk of investors. Most investors are the big part of investors as what we call institutional investors. And of course, the ones who provide the bank loans are the commercial banks. But we will now focus on who the institutional investors are. So you have a huge range of institutional investors. I've put here a list of the major ones: the sovereign wealth funds, the pension funds, the insurance companies, mutual funds, the banks, also the private equity funds and the hedge funds, in general the alternative investment funds, but they are smaller, and you have corporations. So we'll start with sovereign wealth funds. Sovereign wealth funds are in fact pools of money that are derived from a country's reserves, the surpluses generated by the trade activities of the banks of the country, the exports. This excess, these surpluses are invested on behalf of the state, on behalf of its citizens. And so they are invested to benefit the country's economy and citizens. This is what is the intention of a sovereign wealth fund. Sovereign wealth funds that are the largest, and we talk about worldwide $10,000 billion of sovereign wealth funds in total. But the largest ones are mostly oil countries, oil producing countries like Norway, Abu Dhabi, Kuwait, Saudi Arabia. Then you have the pension funds. The pension funds, they are an emerging institutional investor in Europe, already very big, but emerging if we see that public pension is still dominant in Europe at 80% of pensions that are being paid in Europe. The pension plans, the pension funds, they come on top of this public pension or in replacement. So the idea of the pension fund is to pool the contribution of employees and employers, so the contribution from pension plans that are being set up by employers or unions, or that are being set up individually. And that's what we call, there is a mistake here, employers or unions is what we call occupational pension funds, and in fact it's pillar 2, and then you have individual contribution, and this is pillar 3. Sorry for the mistake on the slides. The earnings realized on the investments of these funds generate an income to the worker upon its retirement. And this is the pension that is being paid. So if we talk about sovereign wealth fund or pension fund, there is a dimension of, for sovereign wealth fund, of public interest that can come quite naturally. For pension fund of the employees' interest, we are talking about the pensions, even though it's not always the case. Then come the insurance companies. The insurance companies, they collect and they invest premiums that they receive, and you need to take the expenses to run the business of the insurance company out of this, and then you come with the excess premiums that are being invested by the insurance company. It's a huge amount of money, and the earnings that are derived from this investment are a major profit driver for insurance companies. And as a result, the insurers are key participants in the financial markets because they have large investment portfolio, especially in bonds. They represent almost 10,000 billion euro in Europe. The mutual funds now. Mutual funds, they are investment companies, and they pool individual investors' savings, make investment decisions on their behalf, and collect the returns and distribute them to the investors. They make what we call asset management according to a given strategy. You will have a mutual fund that is more invested in Europe, another one that will be more invested in emerging countries. Then you would have another one that will be invested in certain sectors of activity, and others like technologies, others that will be more industrial, others that will be in another sector again, and so on and so on. You have many very different mutual funds and very various strategies. In the EU, mutual funds are commonly called UCITS funds, and this refers to the regulatory framework that exists for quite a while now in Europe, called undertakings for collective investment in transferable securities. By the way, the transferable securities are those securities like shares and bonds that you buy and you can transfer to someone else. You can sell on the market to someone else. That was what I was referring to earlier on. A large share of UCITS funds in Europe are registered either in Luxembourg or in Ireland, which are major centers for the fund industry in Europe. Then, if we go down the list of institutional investors, you have the banks. In fact, the banks, they are not only commercial banks providing bank loans. The very large universal banks, those that dominate the banking market, those we generally use because they are the most present in Europe, those large universal banks, they dedicate more than half of their balance sheet to activities on the financial markets. And I'm talking of the very large. And these activities on the financial market, they include quite various things. You have product origination, so the fact of creating a new share, creating a new bond for a given company who wants to go on the market. They act as market makers also. And as market makers, what they do is that at any time they are here to buy or sell a given asset, a given financial asset. So they facilitate the market. They also act as prime broker. And the prime brokerage function is an important one for hedge funds, without which they could not live and even exist, because hedge funds, as we will see afterwards, they rely on bank credit. And you have the trading activities of the banks. These are the financial markets activities of the banks. But I would like to add also that those large banking conglomerates that are around the large universal banks, they include not only commercial banking, not only investment banking, so the activities on the financial markets that I just described, but they also include asset management, the fund industry. They manage mutual funds. It also includes wealth management for wealthy private investors with specific types of mutual funds with private equity funds, for example, and so on. They also have, especially in Europe, insurance company in their conglomerates. So the banks, in fact, the big banking groups, they really are present almost all along the chain of institutional investors. Then come these private equity funds, hedge funds, as the two major examples of alternative investment funds that I wanted to go through. By the way, alternative investment funds is a term that is being used especially in Europe as opposed to mutual funds, the UCITS funds. So you have the UCITS regulation and you have the AIF regulation, Alternative Investment Fund regulation. And inside this, you have the private equity fund, you have the hedge funds, you have the real estate funds, etc. You have many different types of funds. So the private equity funds, to keep it short, they directly invest in private company and they take an active stake in the management of these companies. This is one thing. The hedge funds, they use leverage. This is what makes the hedge fund. They use leverage as a mean to increase their returns. Basically, they collect 1, they borrow 9, and then they invest 10 on behalf of those who have given 1 to the hedge fund. So they will make their return on 10, not on 1, which is a big leverage and a big interest also for the investors. It's also much more risky. But what is important is that hedge funds depend highly on bank lending. Also, hedge funds are typically located in jurisdictions such as Luxembourg, Delaware, the Cayman Islands, commonly known as tax haven. Another feature of the hedge funds is that they are open to a limited number of accredited investors, professional investors, and they require a large initial minimum investment. And in fact, those who invest in hedge funds, they are not only individuals, but they are more and more institutional investors themselves. And I will end this list with corporations, because large corporations accumulate cash. And in order to optimize this cash, they invested with the objective to generate returns. So corporations have also become kind of investment funds, or they have part of their activities that is kind of an investment fund. For large corporations, some of them at least, the investment of cash is an important complement to the profits that generated by their core activities. And also one thing to mention, and I'll finish with that, is that this cash is also used for share buybacks to sustain the company's stock value. So, to put it in a nutshell, the institutional investors are various types of companies, and they commonly manage funds and make investment decisions, and they collect returns on behalf of their owners or beneficiaries. Because in fact, each of these institutional investors is in fact a company that has pooled money from various people, pooled money from the state, if we talk about sovereign wealth fund, pooled money from employees, if we talk about the pension funds, pooled money from savers, if we talk about the mutual funds, from wealthy individuals, if we talk about certain mutual funds and hedge funds and private equity funds, who have collected pooled money from people who have subscribed an insurance, if we talk about the insurance company. So there is this dimension of pooling money. And then this money is invested, and we go on the right side of the image, into companies. The institutional investor buys shares, bonds, and other things from the company. But the important thing that I wanted to add at this point is that institutional investors also buy from other institutional investors. And this creates a dimension of major interconnectedness between actors of the financial markets. I already mentioned, for example, that hedge funds are highly dependent on banks, meaning that if a hedge fund has a problem, the bank has a problem. But a fund can also buy shares or bonds from a bank, or from another mutual fund, or from an insurance company as an investment. And the insurance company can invest its premiums in another bank, or a mutual fund, or a hedge fund, and so on, and so on, and so on. So the whole system, the whole network of institutional investors is tightly intricated. Now, how do these institutional investors make their decision? As said already, the decision they are made with the objective, I'll get back, of collecting returns on behalf of the owners of the company. So collecting returns means searching for returns in the companies they invest in. And if you ask these institutional investors what drives their decision making, so what makes them decide to invest in a company rather than another, this is the list of drivers that a group, Fidelity, which is also a large institutional investor, found. They asked a number of institutional investors what were their priorities, the factors that impacted their institutions' asset allocation. So you have in dark green those criteria that have a strong impact, and in light green those criteria that have a light impact, some impact, let's say. So if we start from the bottom, starting from the things that have the highest impact, the past performance of the asset class and the previous experiences with similar investments. So basically, if this has worked in the past, probably it will work in the future, so we take it. Then we have the expected return from asset class. So we could link this up with the economic forecast also, that is a bit above. It's what we expect from this asset class in the future based on the information we have. But this is about financial returns. Then, risk tolerance. This means, are we searching for higher yields, hence taking more risk, or do we want something that is supposedly a safe investment? Meaning probably we'll get less money, less returns out of this investment, but we will take less risks also. Less risk of losing completely our investment. Then you have the time horizon. Time horizon is whether we want the investment back in a short period of time, or are we ready to stay in this investment for a longer period of time. This is also what we call the liquidity of the investment. Consultant recommendation. What do consultants say? Okay. Asset allocation of peers a bit beyond is also is also something that goes into that direction, and this reflects on the herding behavior of financial markets. They tend to do mostly what the others are doing, because if the others are doing it, it's probably that's a good idea and that there are returns to be searched there. And then you have the board dynamics, what the media say, board member emotions also. Are they confident or do they fear something? The reason why I wanted to show you this list is that in a way or the other, it's all about generating financial returns. But never here you see something about impact on society, about societal value, about environmental impact. It looks like it's completely out of scope. So, what does this mean? It doesn't mean that there is no sustainable investment. Some investments are made in a direction that can be positive, or at least neutral, from an environmental and social point of view. It doesn't mean that. It means that by large, very, very large, institutional investors are not concerned about the externalities. They are not concerned about the social and environmental impact of their investments. It's not their priority. This also means that companies are being merely transformed into becoming performing investments. Will they have a good rating? Will they be noted well based on what are the criteria for investment of institutional investors? Will they get money out of their investment? And the rest is not that important or not important at all. So the big question is, how do we get out of this doom loop? Because there are major concerns. First, the pool of capital to be invested is growing constantly. And this is linked to the fact that pensions are being increasingly privatized. So this means that the pool of money to be invested is growing every day unless we stop it. Deposits also are being redirected on financial markets, especially since several years, because the returns or the interest rates are low. Savers, people, are being encouraged to get out of the deposits and go on investments to search for higher returns. This feeds the financial markets also. You also have inequalities, the concentration of capital. All these lead to a pool of capital to be invested that is constantly growing. And this puts pressure because the increasing financialization of our world is coming from there. There is pressure from all this capital that is searching for investment. So the big question, if we take this whole issue of the capital food chain from a societal, environmental perspective, is how to shrink the size of financial markets. Even before the second question, which is also very important, how to redirect capital where it is needed. So there are many ideas that are being suggested, many organizations that are working on these questions. And this is what I will finish with, is with a list that is absolutely non-exhaustive, but that is quite diverse of things that are going on, organizations, reports, etc., with a lot of ideas of how to get out of this doom loop we are in. So there is this project by Frank Bold, the Brussels-based association, which is called The Purpose of the Corporation. And the purpose of the corporation project is precisely asking this question of how can we change the purpose of the corporation that is now to become an organization aimed at maximizing shareholders and bondholders' value. How can we integrate their societal value, environmental value, and make it more important than shareholder value? This is the question raised by the purpose of the corporation. And there are some answers also being proposed over time. You also have this very interesting work and report from the New Economics Foundation, based in London. In this report, entitled Central Banks, Climate Change and the Transition to a Low-Carbon Economy, the authors ask and suggest that central banks, as they have a major role to play in the banking system and as a consequence on the financial system as a whole, central banks could use their power to support a low-carbon transition and to give a direction to investments made by banks and investment choices made by financial actors. You, of course, have the work of organizations, like Finance Watch. Organizations like Finance Watch that work on the regulation of banks and the regulation of the financial system. And this regulation has as objective, in particular, to shrink unnecessary activities on financial markets, and to ask where in the regulation we could put some ways to direct capital here or there. So I invite you to have a look at a number of proposals there. You also have initiatives that has been going on for a while now, led by the European Commission on sustainable finance, and the high-level expert group on sustainable finance has been appointed some time ago, and their interim report has been released this summer, and we are expecting a plan from the European Commission as from February 2018. So let's see how the proposals from the high-level expert group will be taken. Also, some actions by NGOs against one given bank or one given investment company can have results. I've taken here the example of a large bank that has made a lot of communication after pressure from Friends of the Earth that it would halt shale oil financing. I've put, however, a caution here because we need some critical analysis when a bank is doing this kind of statements. Of course, it will be better or less worse than before. It will be better, but we need to be careful on the way they phrase their intention. Here, it seems that it's about stopping the financing of companies for which shale oil financing is the major activity. But what about the very, very, very large companies, energy companies, for whom indeed, in terms of proportion, shale oil is not the priority, is not the majority activity, but in fact they are, however, major actors on the market. And there are various reports and analyses that are being conducted by several organizations. I will quote here the Fair Finance Guide International that made a global case study on banks' investments in a certain number, several dozens of companies, and how they invest either in fossil fuels or renewable energy. And the outcome of this research is that for €1 invested in renewable energy, you have €9 invested in fossil fuels. So we will need much more effort to reach for a transition. But this is a very, very useful kind of research that is being conducted here. Another, and I will end with that, another direction is to consider redeveloping public banking services and to include a public interest dimension in banking. And for this, I would recommend the quite recent book that has been released by Professor Christoph Scherer on public banks that goes into the public banking sectors of Brazil, Germany, and India and makes some comparisons there, and there are a number of information in this report to think about for the future. So I will finish here. I hope you enjoyed it and got interested, and I'm looking forward to meet you again on another webinar.